There's a comforting story we tell ourselves about the stock market, that somewhere out there are people who actually know what they're doing. Ivy League degrees, Bloomberg terminals, decades of experience, analysts who eat financial statements for breakfast and short positions for lunch. And then reality shows up. Because some of the most catastrophic, embarrassing, and genuinely baffling financial disasters in history weren't made by amateurs panic selling on Reddit. They were made by the smartest, most resourced, most confident people in the room. And that should either terrify you or genuinely make you feel a lot better about your own portfolio decisions. Possibly both. This is what happens when smart money gets it spectacularly wrong. Let's start with the most famous example of financial genius colliding with financial reality. Long-term capital management, LTCM for short, because even the name sounds like it was designed to inspire confidence. Founded in 1994, LTCM wasn't just a hedge fund. It was essentially a collection of the most impressive financial minds ever assembled under one roof. Two of its partners, Myron Scholes and Robert Merton, won the Nobel Prize in economics in 1997. The fund's models were built on decades of academic research. Their strategies were so mathematically sophisticated that most people on Wall Street didn't fully understand them. And for a while that didn't matter, because LTCM worked. In its first few years, the fund posted annual returns of over 40%. Investors weren't just happy, they were in awe. The fund grew to manage over $125 billion in assets. Banks were practically begging to lend them money. At its peak, LTCM had leveraged its balance sheet to control positions worth over $1 trillion. $1 trillion, controlled by a hedge fund that had been operating for 4 years. And then 1998 happened. Russia defaulted on its debt. Markets panicked in ways that LTCM's models said were statistically nearly impossible. The fund's positions, which were built on the assumption that markets behave rationally over time, got absolutely obliterated as markets behaved in the most irrational way imaginable. In a matter of weeks, LTCM lost $4.6 billion. The collapse was so severe that the Federal Reserve had to organize a private sector bailout to prevent the fund's failure from taking down the entire global financial system. The two Nobel Prize winners watched their fund collapse in real time. The lesson wasn't that they were stupid. They weren't. The lesson was that being the smartest person in the room doesn't protect you from being wrong about the room itself. But LTCM isn't the only story, not even close. Let's talk about Bill Ackman and Herbalife, because this one has everything: confidence, public declarations, a short position, and 4 years of very expensive stubbornness. In 2012, Ackman, one of the most high-profile hedge fund managers on Wall Street, made a very public bet that Herbalife was a pyramid scheme and that its stock would eventually go to zero. He didn't just quietly short the stock. He held a 3-hour investor presentation. He called it the investment opportunity of his lifetime. He put over $1 billion of his fund's money behind the trade. And then Herbalife didn't go to zero. For 4 years, while Ackman held his position and doubled down on his thesis, the stock kept climbing. By the time he finally closed out the trade in 2018, his fund had lost an estimated $1 billion on the position. $1 billion on a trade he announced publicly, defended repeatedly, and was absolutely convinced he was right about. The confidence wasn't the problem. His analysis of Herbalife's business model had real merit. The problem was the market didn't care about being right on schedule, and as the saying goes, being right too early is indistinguishable from being wrong. And then there's the one that stings the most because it involves Warren Buffett. Yes, that Warren Buffett. In 2016, Berkshire Hathaway began buying shares in IBM. Not a small position. Berkshire accumulated over $10 billion worth of IBM stock over several years. Buffett called it a strong business with loyal customers and durable competitive advantages. IBM proceeded to decline. Revenue fell for years. The technology landscape shifted in ways that IBM was painfully slow to adapt to. By 2017, Buffett had sold most of the position, acknowledging publicly that he had been wrong about IBM's ability to compete in a rapidly changing tech environment. $10 billion, the greatest investor of the 20th century, wrong. And to his credit, Buffett said so clearly. No excuses. No blaming the market, just a clean admission that he had misread the business. Which actually brings us to something important. Because the investors who lose fortunes quietly are usually the ones who can't do that. Here's the pattern that connects every one of these stories. It's not stupidity. It's not laziness. It's something far more dangerous. It's conviction without flexibility. LTCM had models so sophisticated and so internally consistent that when reality disagreed with the model, the temptation was to trust the model over reality. Ackman had a thesis so publicly stated and so personally invested that revering it felt like defeat rather than wisdom. Even Buffett, who eventually did reverse course, held IBM longer than the evidence warranted because his framework told him durable businesses with loyal customers don't just fade away. The smarter you are, the better you get at building arguments that justify what you already believe. It's not a Wall Street problem, it's a human problem, and it happens to be extremely expensive on Wall Street. Psychologists call it confirmation bias, the tendency to seek out information that confirms your existing view and discount information that challenges it. And the more confident and successful you are, the harder confirmation bias hits, because your track record becomes evidence that your judgment is sound, which makes it even harder to accept when your judgment is wrong. So what does this actually mean for you? It means the gap between professional investors and regular people is smaller than the financial industry wants you to believe. Not because professionals aren't skilled, they are, but because the market doesn't grade on credentials, it grades on outcomes. And outcomes are humbling regardless of the resume attached to the decision. The investors who survive long-term aren't the ones who are never wrong. They're the ones who are wrong cheaply, who size their mistakes in a way that doesn't end their game, who have the intellectual honesty to change their mind when the evidence changes, even when it's embarrassing, even when it's expensive, even when there's a Bloomberg journalist watching. Because here's the uncomfortable truth about smart money, it's still money, and money doesn't care how smart you are. The market has wiped out Nobel Prize winners, billion-dollar hedge funds, and the most celebrated investors alive. Not because they were fools, but because they were human. And humans, no matter how sophisticated their models, tend to believe they've finally figured out something that nobody has ever figured out before. And the market has a very consistent, very patient, very expensive way of explaining that they haven't. So next time you feel embarrassed about a bad trade or a portfolio decision that didn't work out, just remember, somewhere out there a Nobel Prize winner watched a $1 trillion fund collapse in 6 weeks. You're in decent company. Drop your worst investment decision in the comments. Let's see who wins.